Let me now bring on board Funny Shekhar, Fund Manager with Angel Stock Broking. Funny morning, thank you for joining us. Funny, next 7 trading sessions, we are pitted against 2 important events. First, Infosys numbers on Friday, then credit policy on 17th. How much of a catalyst do you think both these events potentially could be for our markets?
Well, in the near term, they are huge catalysts because there has been a lot of debate going on whether Infosys is going to give guidance or not. So, what Infosys does on Friday will have a huge bearing on the IT universe and generally on the market sentiment. And of course, there has been a lot of run-up to the April 17th monetary policy of RBI, and people are expecting at best a token 25 basis cut. But I think in the medium term, if you see, I would say that the import of these 2 events is not going to be significant for the markets if you generally exclude the near-term sentimental impact, because in the medium term, earnings are unlikely to be affected either by a 25 basis points rate cut by the RBI or what Infosys does and generally what the IT pack does. Because if you look at the macro numbers, and the trajectory of the monetary policy cuts over the next 9 to 12 months, it is clear that rates might not go down by more than 50 to 75 basis points. Investment cycle is still some time to go. We do not have any clear signs. What will continue to do well is consumption on the ground, which is more than fairly priced in the markets. So, all in all, there are no surprises as far as from which pockets earnings will do well. Overall basket for the index earnings, we would be lucky if earnings grow by 12 to 14%, which also means that there is not significant valuations or surprises in store. So while we are trading at 13 times, if we can hold on to this 12 to 14% earnings growth for the next 2 to 3 quarters, we might marginally re-rate ourselves to about 14.5 times, which means that the market might be in for a 16 to 17% kind of appreciation. And conversely, on the downside, there doesn't seem to be more than 7 to 10% downside. So, broadly, it's a stock-specific market, and one has to focus on pockets where valuations are ripe for some sort of a surprise in earnings.
But Funny, do you think earnings will bottom out this quarter, or do you think there are some more quarters, or rather 2-3 quarters more of pain which are left?
I think the earnings have already bottomed out in the last 2 quarters, the September and the December, and this quarter growth is likely to be much better than what we saw for the last 3 quarters. So I am expecting 12 to 14% earnings growth. And in the backdrop of inflation trajectory remaining fairly moderate, and this weekend we also saw reconciliatory noises coming out of Iran, and toning down of the standoff between US and Iran, and hopefully that will have some rub-off effect on oil, and if that happens, that can't be more positive for India. So if these things pan out the way one is hoping for, then I think 12 to 14% earnings that we are delivering, which is higher than what we did for the last 3 quarters, might actually be some sort of a bottom for the next 3 to 4 quarters, and we can only keep getting better and better. So all in all, for FY13, if you are penciling in a 12 to 15% kind of earnings growth, I don't think at the end of the current year, that is FY13, you will be very much off the mark.
Funny, have you looked at the CDBT circular which came on Thursday, which clearly indicates that the Mauritius route in coming months will be blocked?
I haven't looked at that circular, but if that were to happen the way many people fear in the market, then of course it's going to have a huge near-term knee-jerk reaction. But there is an old saying in the market which is just like water, money will find its own level and it will find its own way to get into the markets as long as markets are attractive. So while you cannot be banking always on high liquidity to bail you out of excessive valuations, you cannot be penciling in lower liquidity and the market valuations to remain at abysmal levels like 12-13 times. So I'm not too much concerned in the medium term. However, there might be impact in the near term.
I don't have numbers which tell me that how much money comes from the Mauritius route. But so far this year, foreign institutional investors have pumped in about $8.5 billion. And a rough market assessment is that nearly 50% of that money this year has come from the Mauritius route.
That's true, and the majority of that money had actually come in February. So, as I said, there might be a near-term impact for maybe at best a quarter, but I'm sure that the money will find its way as long as valuations are fair.
Funny, at a time when market men clearly expect earnings to disappoint and not surprise on the upside, how are you putting money to work?
We have been trying to identify sectors, especially in the consumption basket, the subsectors there in the consumption basket, which seem, more or less fairly valued to us. Because while on the one hand, you have stocks like a Jubilant or a Lovable, which have run away on very high valuations and expectations. On the other hand, you have stocks, say, in the print media sector. A good case in point might be Hindustan Media Ventures, which is still available at a reasonably good valuation, around 12 to 13 times. On the other hand, you have the entire agro theme, stocks such as a VST Tiller, although having very low liquidity, also available at a very attractive valuation. So there are these kind of ideas, however not many, which are available, and generally not in the large cap segment. So one is quite choosy, and I would be candid here that one is unable to put the entire money to work. So there is a fair bit of cash that is lying with us for want of opportunities. But I think the flavor of the market is that you don't rush and put all your money to work just because you have equity allocations, but just be choosy in what you buy.